From the morning reading, U.S. stocks gap lower following Asian and European markets down. Find support and bounce, forming divergences, flags, and hammers. All 9 sectors moved lower on Monday, the first trading day of 2016. XLE, XLU, and XLP were the strongest sectors, while XLF was the weakest sector. Breadth weakened as decliners led advancers, 2.16 to 1 on the New York Stock Exchange and 3.25 to 1 on the NASDAQ. The number of securities trading at a 52-week low nearly tripled on Monday. That could be taken as a sign that investors will begin to panic and cause cascading selling pressure. But there is little evidence for that. Past instances mostly led to mixed returns in the shorter term and significantly positive ones longer term, with no further bear markets among them. Though this borderline silly, Monday's loss was among the worst in the history of the S&P 500 for the first day of a new year. It had lost more than 1.5% to start the year 5 other times, and all of them saw the S&P rally during the next week by an average of 4.9%. This occurred in 1932, 49, 80, 83, and 2001. Selling pressure over the past 3 days has been enough to push the average down pressure over the 3 days above 90%. Since this data begins in 2002, there have only been 5 other times it has exceeded 90%. All 5 led to a rally over the next week, though there was nothing consistent beyond the short-term tendency to rebound. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:58 a.m. Central Time, and I'm recording this in preparation for the market day of January the 5th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And we did have quite a bit of action again last night. Indeed, at the time of this cut, the S&P futures were down some 15 points, or another 0.75%. Russell futures were down about almost 0.5%. NASDAQ futures also down about 0.75%, as was the Dow, down about 0.75%. Crude oil was down about 0.2%, as is the euro. And then on bonds, they are up about 0.2%, and gold is up about 0.5%. And overseas action, the weakness continues. China down another 0.25%. Hong Kong down about 0.2%, Japan down approaching 0.5%, Germany about 0.75% down, and the United Kingdom essentially scratch. In terms of macroeconomic reports for today in the United States, we have just one yellow flag report, total vehicle sales, so not much on that front. In terms of tomorrow and looking ahead, we have the ADP non-farm employment change, and of course, first Friday will be this Friday, so we'll have the monthly employment report coming up out there at the end of this week. Trade balance also coming in tomorrow, and then ISM non-manufacturing, PMI, factory orders, and the regular crude oil inventory. We have FOMC minutes coming out tomorrow afternoon. So there's quite a bit on the schedule for the back half of this week, including a full slate for tomorrow and one of the most important macroeconomic reports on Friday with the employment report. And let's take a look at volatility conditions. Let's focus first on our current short-term VIX. Big pop in short-term VIX yesterday, up almost to a 22. You also see a big pop in the skew, up to 140, and this will give us something around about a 8 or 9 times normal probability of a 2 standard deviation move. And obviously we did have that yesterday. We had, as you can see, 2 standard deviation moves on the Russell, the NASDAQ, and the Dow, and well over a 1 standard deviation move on the SPX. We've been talking about the frequency of standard deviation price moves of late, and you can see in the last 2 trading weeks, there have been some 8 out of 10 sessions for the S&P that have been one or more standard deviation moves. So we have two kinds of price volatility we talk about here. One is the fear premium and how much is volatility and fear being priced into our options, but the other is actual price movement, which can sometimes be quite a bit more and sometimes two-sided without any fear being present. At the very least, we've had significant price volatility of late, and you need to take that into account in your trading actions. In terms of the, let's go to this one. Let's go look at the charts for just a moment. First of all, we'll go to the SPX, and I want you to note two things about yesterday's price action. Obviously, big gap, then just huge falling action, then a large significant wick off the bottom. And note that this wick, undercut this prior swing low, this important area. We had this line drawn here before yesterday. It was an area of prior resistance that once broke through became support, then became support again, and then yesterday undercut that just enough to run stops of people who had put stops just under this area, and then turned and then closed well up off the bottom. So a significant bullish finish for the day at the, and indeed, if we look at the last 5-minute charts, we'll see that this was all really done in the last 30 minutes. This action coming off that bottom, much of this accomplished literally in the last 5 minutes. Now, that being said, this is really quite bearish action. We broke down through certainly at least diagonal support with the action from Thursday, and then yesterday big time confirmation and further breakdown of that. And then also you could argue that we had a breakdown of horizontal support, though I would basically call this the area. And what's important about this is that it was the area. It didn't last very long. There weren't a lot of contracts being traded through that area. It was quickly recovered by the bulls. So I would call this a similar bottom, and that horizontal support is still holding in the general approach. Now, that being said, we're down and breaking through this morning with more weakness, and let's see what that looks like on a futures contract. Indeed, so far on the futures contract, we have shown some weakness from yesterday's close, but have not yet challenged the former swing low. And this area has got to hold. If this does not hold, we had just a handful of trading sessions with rip your face off bullish action coming off this V bottom swing in this area back at the end of September and early October. And just as fast as it ripped up through this area, it could very easily rip back down and come all the way down to the 1860s area. So this is a very, very important area to watch. There could be some, and I probably need to redraw these fib extensions on the ES, but there could be some fib extensions down here. So I think somebody was telling me yesterday that this represented about a 50% fib retracement between the high and low, between here and here. The 618 is probably sitting out here somewhere around, just guessing, around 1940 or so. That could be an area in which you get some support, but other than that, there's really, a lot of clean air that could be ripped back through, coming back down through this. So if you see a significant and confirmed breakdown, not just run a few stops, a few ticks past, but a significant and confirmed breakdown past this we'll call it 1975 area on the ES futures, that could be pretty significant, and certainly risk in the market would become quite elevated if that were to happen. Let's take a quick look at the Dow, and we're going to go ahead and use the futures contracts because of this overnight action being so significant. Again, very much like the SPX, very similar picture. Now you notice here that this breakdown yesterday was significantly below these former support areas, though it came and turned right on the bottom of the cloud. And then NASDAQ futures, again here, broke through in a more significant way yesterday, but we'll have to see if this area holds. If we get through about 4,400 on the NASDAQ futures, then we also start to see the potential for a cascade, a waterfall blowdown, much like we had back here in August. This is a potential and an increased probability of happening if we get through, around 4,300 especially. We could easily drop all the way down to this 4040 area, or even down to the 4,000 area on the NASDAQ. And then last, let's look at the Russell. And significant breakdown through its former swing lows. It's been the weakest. It had formed something of a megaphone pattern and clearly has broken down through that, ran up and retested over the little bit of Christmas rally that we had, and then broke totally down and obliterated that action with yesterday's price action. Let's look at the futures. And this is the volatility futures. And you see clearly climbing here, and about to break out of the cloud here, and we're up over 20, and this is definitely not the realm of bullish traders. This is definitely entering the realm of more bearish type patterns. And then bonds. Bonds will be the last thing we'll look at. Bonds have come up off these recent bottoms with this action yesterday. We were as high as about 155 and almost a half yesterday. We'll see where this goes. But if the market continues to break down, there's not the same amount of fear around interest rate changes on these long bonds anymore. We now have much better definition over when and how much to expect. So I guarantee you that's already being priced in to the long bond. So this is more probably a reflection of where is the dollar going and where is the amount of fear in the broad market, and this will retain its safe haven status and have, the normal correlations I would expect would start to work in the bonds more so than perhaps we've seen in recent months. So we'll see if that comes true going forward. Let's go on to our daily report. A number of important changes here today. And most importantly, of course, in the last couple of days, we've had this intermediate term phase opinion break down to phase 5, the break of horizontal and diagonal support. We clearly had the break of diagonal support. Remains to be seen if we truly have a break of horizontal support, which would make this even more ominous. In terms of the portfolio investor posture, it's about as ugly as it can get. IBD status after the 12th confirmed uptrend signal of 2015 failed immediately. And in fact, from the time it went to confirmed uptrend, it lasted hardly an uptick. And almost immediately after 3 trading sessions, including yesterday's ugly action, immediately went back to market in correction. So we continue to get frequent whips going back and forth with this ranging market that we've had now going for over 13 months. IBD status now has deteriorated to this market in correction. Accumulation distribution score also equally ugly, with the S&P at a D-, the NASDAQ also a D-. GMI index fell to a 1 out of 6. It's been on a sell signal since 12/10. That author remains in cash. In terms of the decision point scoreboards, we've seen some changes here yesterday, most notably in the short to intermediate term. The S&P 500 large cap, the most important one, outright bearish with both signals in the short term and now one neutral sign on the intermediate term, so it's starting to bleed up. Also, NASDAQ, decidedly ugly on the short term. In fact, they're all decidedly pretty ugly on the short term. Not all outright all down arrows, some neutral signs here, but still, when you take the consensus of these mechanical signals and you say, what is our portfolio investor posture? It is decidedly bearish, at least in the short term, and starting to bleed through to the intermediate term. Long term was already mixed, so very much a market in transition with a distinct bearish bias at this point. And we'll have to see when these things start to stack and line up as to what that might tell us if we eventually enter this transition market to the bull side or to the bear side. But right now, you'd have to give the bear side a decided advantage. In terms of the intermediate term market posture, this is also ugly for the bulls at bearish with a bearish sentiment line. You see the position sizing opinions on both systems coming in with reduced position size. On the portfolio investor position sizing opinion, that's now dropped to 0%, and on the volatility based system dropped to 50%. In terms of that intermediate term market posture, bearish, and indeed it is just a few points away from being very bearish. If this S&P and the most important index drops below 50, that would be considered to be very bearish. And as such, it would be calling for no new short or intermediate term bullish trades. And you see the Dow and the Russell are already in the very bearish camp, and the NASDAQ, like the S&P, is very nearly so. So this is getting about as ugly as it gets without an outright breakdown. In terms of the hedge warning status, we've increased this to a level 2, back to red light. We had dropped this to level 1 for 2 or 3 trading sessions as we had some, nicer price action that looked like we were going to move up into the range, but very quickly has deteriorated. Equity risk short term, currently a 5 on a 1 to 10 scale. Stocks intermediate term also a 5, so both still neutral. And this kind of reflects again what we have as a transition. It's still in a range and has not broken out of the bottom of that range quite yet, but at the same time, obviously hedge risk levels are elevated. Remember that hedge risk levels are an opinion, and it's not a prediction that we're going to move down or how far we're going to move down. It's simply an opinion about the level of risk that is currently present in the market, and certainly elevated risk conditions are present. Level 3, of course, is our highest risk, and that would happen if we were to make clear breaks of these important horizontal support levels. That's really the only thing left preventing us from going to level 3. In terms of the specific metrics, you can see a sea of red down here. Market in decline, sharp increase warnings have both fired off. VIX futures are up over an 18. The distribution day count, because we're in market correction, goes to reset, and that in itself is its warning. VIX phase is increasing. The skew is actually up over 140, so that gives us about a 12% probability of a 2 standard deviation move in the next 30 days. And this certainly has been kind of a constant for the last 2 months. Very high skew ratings, and we have seen indeed very, very high number of standard deviation moves occurring. Current week out expected move in the SPX is a very high 59. This is actually a little lower than it was at some points yesterday, but it's still at the same time pretty elevated levels. We often see this in more normal trading closer to a 30. In terms of new highs, new lows in the New York Stock Exchange yesterday, you see well over our threshold of 300 to consider this a warning. 640 new lows against only 60 new highs. In terms of the intermarket risk aversion indicators, we now have 2 out of the 5 are flagging as risk off, and some of these are starting to roll over but have not yet crossed. So this continues to be also another area where the warnings pile on. In terms of the sentiment indicator, the fear and greed index, you see this has dropped now to a 42, and you can see some of the prior ratings. So things are definitely, not in a great shape there as well. In terms of special opinions, VIX is now clearly outside the acceptable window to initiate new positions for novice traders. Though we do note the market has been chopping in and out of the acceptable window. That being said, also more and especially very aggressive traders can take advantage of these elevated levels of fear premium that are currently available in the market. But you've got to accept that the probabilities of significant delta and vega moves are clearly with us. In terms of other special opinion strategies, covered calls and put selling, again, conditions are not acceptable to initiate new positions for novice traders. but again, we have to recognize they've been chopping in and out of acceptable thresholds. If you do take a position, especially if you're a novice trader, at the very least, be very defensive and use a number of the defensive tactics that I mentioned here to be able to set up that defensive position. Keep that position size well in hand, and especially when you're talking about selling puts, strongly consider defined risk positions and position size on the scale that you are absolutely willing to own. Keep all that well in mind. In terms of sector specific, you can see a sea of red here, only utilities holding up. And of course, the utilities is the bastion of defensive holders. So the fact that that's the one that's still holding up, it will eventually turn down as well if the market continues to be down. And indeed, if you see on the percent change yesterday, everything was red, including utilities losing 1/4%. Energy was actually the best performing sector yesterday and was nearly scratch. The other thing we like to look at here is this consistency of performance, obviously, especially in recent trading sessions where we've had an awful lot of going back and forth with the price action in both directions. But 1 day, 5 day, 1 month, even into the 3 month and year, some of these sectors are showing significant negative behavior. Even on this 3 month, remember 3 months ago was coming off of the last correction, and that gives a quite favorable comparison, but that's also starting to get in trouble as we revisit those former lows across the various sectors. Okay, that should be enough for today. And I'm not going to spend any time on the special opportunities today. We've already gone over 20 minutes. But that being said, I'll just flip. And if you've got a special interest, just hit the pause button and you can get the hyperlinks. Obviously, if you find this is helpful to your trading each day, we greatly appreciate you subscribing to the YouTube channel. It's free, and by subscribing, you get a heads up when content is posted. Also, you can like us on YouTube. You can retweet us to your Twitter followers, to your StockTwit followers. You see all the various social media there where we are present. Direct feedback can be sent to support@falconglobaltraders.com. Disclaimers, as always, hit the pause button if you need more time to review. And then at the bottom, you see the full hyperlink that takes you to the full out disclosures, and you can go there to get that. That's enough for today. We hope that you have very good trading in this very troubled environment. And we'll be back here tomorrow morning before the market opens with the Falcon Global Market Preview. Good trading.